For a more expert analysis of that, we're joined by Leland Miller. He's president of the China Beige Book International. Leland, good afternoon to you, and thank you very much for joining us. It's wondrous, isn't it? The Chinese government says they would like to grow at 7.5%. In the first quarter, they grow at 7.4%, and in the second quarter, bang on, 7.5%.
What a miracle. What a miracle. That's exactly right. I think people are very skeptical of the latest number when they're seeing problems on the ground. They're seeing deceleration in most sectors. They're seeing significant problems in property. And then all of a sudden the government a few weeks ago starts talking about improvement and strength and guaranteeing growth, and all of a sudden you see a 7.5% number. So people are right to be skeptical.
But, you know, some of the other data as well seems to have pointed towards a bottoming out of the economy, if we may say so, or some signs of recovery. For instance, if you saw new bank loans data that came in yesterday, or today's industrial production number, they're all very positive, indicating that maybe the economy is improving from here on and that the second half will be even better.
Well, I don't think we believe at all in the concept of bottoming out. China's economy is slowing right now, slowing because it has to. We're seeing deceleration across all sectors in quarter two. We saw the same thing in quarter one and also in the past several quarters before that. The Chinese economy is slowing down. I think the problem with talking about bottoming out is it suggests that there is a rebound to come based on some mythical formula of more credit and more misallocated capital. But I think the reality is, if the Chinese government's official story is to be believed, that means that they dumped in a lot of extra credit into the economy in the last month, and they did a lot of investment spending in the last month, and that sort of buoyed the economy back up. That only is not a solution. That makes things much worse. And if they continue on this path, it's a real problem.
Oh, well, a lot more credit even while they're chasing down the shadow banking system. So I agree there are too many contradictions out there. What is your real assessment of what rate China is growing by? Is it 7% maybe, or even less than that? And would you say, given the accelerated rate or pace at which China has been growing the last few years, that even if it did manage to do only 7% growth, that's not a bad number at all?
Right, and that's why we get away from the entire GDP discussion.
Okay.
GDP is a measure of aggregate growth. It's not a measure of productive growth. So what we try to talk about more is directionality. You know, how are sectors faring? How are regions faring? And how is that guiding the national economy into either deceleration, healthy or not, or into growth going forward? And what we've seen, as we talked about before, was that we've seen a broad deceleration across sectors throughout the entire economy. Not one sector of ours improved from Q1. Manufacturing and agriculture were static. But you're seeing a slowdown in growth. It's not necessarily a bad thing. But then you look in the credit markets and you're seeing a drop in loan demand. You're seeing rates in the shadow banking sector actually drop because of lack of loan demand. So these are important things to take in mind, and they're a lot more important than following the headline numbers such as GDP.
I know that's fair, but nonetheless, Leland, I mean, how China does is so central to the recovery in the global economy. It's central to the fortunes of so many industrial sectors. For instance, you know, when it comes to natural resources, we had Rio Tinto saying that it's increased its iron ore output today and stepped up shipments to China. So all of these markets connected to how China will do, which is why I'm trying to get a better sense of what you expect will be the second half performance in China, you know, and whether, and some number that is indicative of whether it is on a recovery path or not.
Okay, well, since you're going to pin me on it, I'll say this. China's slowing down, full stop, period, going forward. If they want to use some of their old tricks, which is stimulus, which is investment spending, they can buoy the numbers for a quarter or two. It is possible that they continue that in the second half of the year. I would think that that is not where they're going. I think they're trying to manage a slowdown. All of our data in the growth sectors and the credit sectors are showing that they are trying to engineer a healthy slowdown. So I would not put too much stock in what the official numbers are, the official story. We're seeing a deceleration. It's good for China, and I would expect a deceleration in the second half of the year, not an acceleration. China's not going to speed up. It doesn't have the levers to do that.
So that's a warning to the crude markets, that's a warning to all commodity markets, and that's a warning when it comes to global economic GDP growth as well.
I think that's right.
All right, Leland Miller, thank you so much for joining us, and thank you for that reality check. That's the story coming out of China today.